Assalamu alaikum friends, welcome to lecture 27 of SBL. Today we are going to cover the last topic under your section E, that is organizational control and audit. Okay, before this I had one more lecture which was on internal control, and this is the second under that same topic, and this is the last. Before we move on to section F, that is finance. There we are going to do lots of questions, ratios, Excel and all those things. And it will be pretty fun because I know this topic is a little dull compared to others because it's more like theories, lots to read than the calculation or anything like that. But it's audit. I mean, some of your auditing knowledge will help you here because I told you SBL compromises the knowledge of all the papers combined: tax, audit, performance management, your financial management, your SBR, everything. SBL is like a full package, you can say. That's why you will always come through similar things in SBL which you have covered in other subjects in detail. SBL will be in less version, which is audit. So in audit and compliance, today we are going to cover what is the importance of internal audit. What are the factors that affects the need for the internal audit? Why auditor independence is so important? What are the threats that auditors face? What are the roles and why audit committee is set up? And why you need to report on the internal control to the shareholders. If you have done the AAA, this is nothing for you. Trust me. But if you have not done it, not an issue. You have already covered it in your AA, audit and assurance, right? So you know these things. I mean, it's just like a small revision. Nothing new is here in this area. Okay. But why it is there in strategic business leader? Because strategic business leader, it's a business. Okay. The word strategic business leader, as a business leader, you should also know the knowledge of audit. That's why we have all the things: tax, finance, audit, everything. I told you it's a full package. Okay, so that's the reason. Now, this table, okay, will tell you, it's an overview of what we are going to cover in this lecture. So we start with audit and compliance. Under this, we are going to first go through internal audit. What are the roles? What are the need for IA? What are the features of internal audit? What are the types of audit work? Then we are going to go through the auditor independence, why it is important, and the threats to that independence. Then we are going to cover the audit committee, how it is made of, and the role. And lastly, the reporting to the shareholder. You need to report to the shareholder. So let's start with the internal audit. What are the roles of an internal audit? Any organization should know this because every organization, more or less, whatever the size is, okay, unless they are very small, will be having an internal audit in that company, right? Internal audit is also basically, see, the difference between internal and external audit is, internal audit is an employee of your company. Okay, external audit is someone who is not an employee. You hire, I mean, the auditor comes from outside and audits your company. But before going to external audit, you first need to know internal audit because they are your employees. What are the rules? Number one, they review your accounting and internal control system because auditors are the one who have the knowledge of this area, internal control as well as the accounting. They review. Second, they help you with the identification of any risk in your business. Third, they review the economy, efficiency, and effectiveness of operation. That is the 3E, you can say. In the public sector, this is very helpful. I mean, see, auditors just do not audit financial statements. They audit. We are going to go through the types of audit. Okay. Then they review whether you have complied with the laws or not. They see the financial as well as operational information. They do special investigations if required. For example, if a fraud is suspected, internal auditor is the one who's going to do that special investigations. Now, examples of the audit types. These are some types of audit. Financial audit, we all know that, where you make a auditor's report. Operational audit is there, as we told about the 3 A's, right? Economy, efficiency, and effectiveness. Project audit is there, where you see whether the project is going in line with not. Value for money audit, 3 E's. Social and environmental audit. Okay, we have other types of audit. They might not be compulsory, but now the organizations are working towards it to make it also compulsory like financial audit. Maybe in the future we might need a compulsory report on this audits also, right? Like how we focus on our financial audit. Then we have management audit. You definitely don't have to know the details of all this audit. In the exam, they will not ask you. Just knowing the types is enough. Okay. Now, what is the organizational structure of internal audit? You should know. First, this is how it is set up. Okay. You will be having a chief internal auditor. Okay. That chief internal auditor will be responsible to the audit committee. They have to report to whom? Audit committee. Okay. You'll be having this internal audit team. It's just not one auditor who is reporting to audit committee. You'll be having an internal audit team. That team is going to report to the person. Which person? Chief internal auditor. Out of that, in the team, there'll be one chief internal auditor. So you report to that chief internal auditor. That chief internal auditor only will do the communication with the audit committee. This is the basic structure. Okay, but in large organizations, the internal audit function will be a separate department only altogether. And in small company, okay, individuals only can perform the specific task. There might not be a full-time position for it. And some companies, they can outsource this internal audit function also. Yes, even internal audit function can be outsourced even though they are done by your employees. It's possible. It is often given to what? The large accountancy firms. Okay? But if you are giving it to someone else, remember the independence requirement of SOX, that is the Sarbanes-Oxley Act. You have to take care of it. They have to be independent. Independence has to be taken care of in any condition, whether you outsource, whether you are the internal auditor who is doing, whether an external auditor, it matters. Then we are moving ahead to the factors. Okay, now we know the functions of internal audit. Now we are going to go through the factors that affects the need. Okay, number one, depends on the scale, the diversity and the complexity of the company's activity. For example, your company is very small. Okay, that time you don't need an internal auditor. Now the company has expanded to a larger scale. You do need an internal auditor. You have to see whether your finance is okay, whether your internal audit is so internal control is working or not. For that, you need an internal audit. Same way for diversity. Before it was in one line, any individual could check. Now it is diverse. Now organization can sometimes become complex also. So you need internal auditor in this condition. Second, number of employees. Huge number of employees, you definitely need an internal auditor. Third, cost benefit. You see, whenever you need an internal auditor, you have to see the benefit has to be more than the cost. Otherwise, not worth it, right? If your organization structure changes, reporting process or underlying information system, so this will affect the need for internal audit, right? Key risk is changing. Okay, depends, it could be internal risk or external risk. You need an internal auditor. Why? Because we earlier we went through the functions of internal audit. It says risk management. I mean, they identify the risk, internal auditor. So if your key risk changes, who will identify? Internal auditor. So you need internal audit or not? You do. If there is any problem with the existing internal control system, see, when your internal control system is working perfectly, company is small, individual employees will be able to take care of it, right? But the moment existing internal control system is not working, only internal auditor can come and solve the issue because they have the knowledge of internal control system. Other employees will not be able to cope with it. And increased number of unexplained or unacceptable event. Internal auditor can come and rescue you there. If events are unacceptable, you cannot understand the impact it will have on your company. It might sometimes increase the risk. Sometimes it can give you an opportunity. Internal auditor can come and help you. Okay, make sure you know these factors because in your case study that will be given to you in SBL, you have to see whether these factors are there or not before you can comment whether internal audit is needed or not. Then, why internal audit is important? Because A, it is required by the statute. B, codes of good practice, corporate governance says so. Third, it is an independence check whether your internal control is working or not. D, management control. You can have a control over the management through this. See, internal auditor, whoever the external or internal auditor means what? They're like a supervisor. They're like a watchdog for your company. They will see how the managements are performing. They are there for the benefit of shareholders, on behalf of shareholders, like a shareholders agent, watching over the management. So it's a management control also. E, during regulation, okay, for regulators, it's a reassurance. Having an internal audit means your company is independent, internal control system is working or not. They can give an independent check, they can give management, so it reassures the regulators and investors. They do not have to worry so much. Imagine if your company does not have an internal auditor, how much regulators will pressurize you, because they cannot be sure whether your company is in good uh, terms or not. Also, it helps to ensure the effectiveness and the efficiency of operation, whether the operation is going fair enough or not. Underpins investor confidence. It gives a confidence to the investor. Remember that if you auditor is there, you become more confident in that company to invest in that company. But without an auditor, you will not want to invest in a company. Now, third, auditor independence. Why auditor independence is so important? See, if auditors are not independent, even if they give you any report, any opinion, will you value it? Will there be credibility for it? No. Auditor's job is only to give independent opinion on their own. What is the financial health? What is the operational health of the company? It's like they are giving assurance. So they have to be independent when they are giving assurance about something. It is an independent objective assurance activity, internal audit. Even for external audit also, but we are talking about internal audit, right? Independent objective, not subjective, objective, based on facts, evidences, assurance activity. So they have to be independent. Second, if you are not independent, your activity will not be carried out objectively. Here and there, you will be keep on being biased. Your decisions will be biased. You'll be influenced by people. So decision activity will not be objective. And if activity is not objective, it is subjective. It's harmful for the organization in the long term. Maybe in the short term, you will somehow cover it up, but in the long term, it will affect. Biggest example is you take the Enron's case. What happened in Enron's case? The auditor knowingly they were helping the company. Arthur Edison was helping the company to hide the fraud, and the result is in front of you. Because of that, we have now Sarbanes-Oxley Act in 2001, or I think 2002. Because of that case was so massive because the auditors were not independent. Okay, so your auditor have to protect their independence. Third, what is it? It is independence is assured in part by having an appropriate structure. To make sure that auditors are independent, you have to have an appropriate structure. Okay, in the internal auditor's work, and also for their ethical and work standard. Independence has to be assured that they are independent also in their ethical and work standard. Now, what are the risks if auditors are not independent? These are the risks. You will fail to report control breaches. If there are any control, internal control failure, deficiency, you cannot report it. You will fail if you're not independent. Any discrepancies, auditor will ignore it, which is not good for the organization. Back down on matter of principle. Wherever you see out of the 5 principles of code of ethics are being breached, you will back down simply because you are not independent. That means company is unethical. Accept explanations without checking. Auditor's role is only be to check without accept, like before you accept anything, check whether the facts given to you are true or not. You have to practice professional skepticism, right? Turn a blind eye to unethical practices, as I told. You know practice is unethical, but you are not caring of it. And you are giving positive feedback where it is not deserved, which you know is not true. Now we are moving on to the ethical threads. Because if there are no independence, ethical thread. Because of ethical thread, this could be the some reason why auditors might not be independent. And this threads needs to be minimized. They need to be managed. But before that, you have to know what are the threads. If you do not identify the threads, how can you manage the thread? Right? So you have to know it. What is it? Threat to independence means what? Anything where the opinion of the auditors will be doubt. They'll be doubted. That is the meaning of threat to independence. No one is going to rely, no one is going to trust the opinion of the auditor. That means threat to independence. Okay? And threats could be real or perceived. Maybe you're perceiving in your mind that this is a threat, or it could be real also. Now, conceptual framework in the ACCA's Code of Ethics, they provide examples also that affects auditors. Okay? It affects both internal and external auditors, by the way. But there are some things which affects internal auditor more than external, and some which affects external more than internal. And Code of Ethics also gives you examples of threats that normally affects the external auditor. You should know your Code of Ethics. What are the 5 principles, fundamental principles? Do you know? If I ask you. I've done a lecture on this previously. Yes. Confidentiality. Then objectivity, integrity, professional competence and due care, professional behavior. Yes. You have to know it. And you have to know the 5 threads also, which we are going to cover in this lecture, don't worry. So threats to auditors independence. There are 5 types of threat, which you have went through your AA. Now again we are going to go through SBL. Self-interest threat. That means any kind of financial interest you have in your client. Okay, that could benefit the auditor. That is known as self-interest. Auditor himself has some interest there in the client. Hence the word self-interest. Second type of thread is known as self-review thread, where the auditor, he himself prepares the financial statements and he is only reviewing his work. Even though he does not prepare financial statements, he must have given some services, maybe not on his services. Now he's reviewing his own work. It's like you are correcting your own mistake. Self-review. Third, familiarity thread, where the auditor becomes very friendly with the client, maybe due to they have been working for the same client for, let's say, 5 years, 7 years. Fourth type of thread is advocacy thread, where the auditor stand up for their client. They promote their client's position. And the fifth is intimidation thread, where the auditor is subject to pressure from their client to do things which are not ethical. So these are the 5 types of thread. You have to remember these 5 types of thread and what it means. And the examples. We are going to go through the examples also. Now, these are the examples. And how to recommendation means how to overcome them. You also have to know the safeguard. Knowing the thread is not enough to give you full mark. Okay. For example, auditor is owning shares in the client company. I mean, where the auditors are going to audit, in that same company, auditors are having shares. Okay. Second example could be the audit firm's pension scheme owns shares in the audit client, their pension scheme. But in either way, it's a threat to independence. This makes auditor become dependent on the client. They become less independent. So how do you do this? Okay. Before recommendation, we'll understand the impact. Okay. Because of this, if any adverse event happens, auditor will not take care of it. Okay. Auditor will not qualify the audit opinion, whereas they should have qualified the audit opinion, but they will not. Why? Because if they do that, it will have an adverse effect. If they give a qualified audit report, it will have an adverse effect on the share price of the client. And if share price of the client gets down, who is going to get affected? Indirectly, the auditor. Auditor has shares in that client company. So auditor wants to protect his shares price in the client. So due to that, even if he knows he have to give a qualified audit opinion, he will not give it. How do you overcome this? Simple. Do not hold shares in the client company. Auditors cannot have shares in the client company. If you're having shares, sell the shares. Second example is loan and guarantees, where either the auditor is giving the loan to the client or the client is giving the loan to the auditor, whatever it is. It's a risk. unless the loan is given in the ordinary course of business, like bank loan you have taken. The auditor can take a bank loan, but not the loan from the client. Maybe your client company is like bank, maybe you are auditing for a bank, you have taken a bank loan, that's okay if you have taken it in the normal course of business. Okay, due to this what could happen? Same thing, same reason, auditors will not qualify the audit opinion. Okay, and remember, in case if the client goes out of the business and if unable to repay the loan, sorry, the auditor does not give a qualified audit opinion because he thinks that if the client goes out of the business through your qualified audit report, they might not be able to repay back your loan. How do you overcome this? Do not accept, do not either make or do not accept loan from them. So you don't give loan to your client, make sure your client also does not give you any loan or guarantee. Simple. Third thread, having close business relationship. This is like a familiarity thread, right? Where the auditor could be a director of the company, or audit firm might have joint venture with the client. So let's explain this. Same, they will not give an qualified audit report because if they give, it can have effect on their business relationship. So simple recommendation, do not have any business relationship with the client. Then we have family and personal relationship. Here, maybe the director's spouse is the director of the client company, or member of the audit team is living with the member of the client staff. You know, some kind of personal relationship is there among the client and the auditor. Because of this, okay, auditor cannot maintain professional standard and cannot maintain their personal relationship. They'll be in always conflict of interest, whether to be professional, whether to have professional standard or to maintain the relationship. It will often upset them. So because of that, independence is lost. So simply, do not, if you're having it, if the auditors are having any family in the client company, they should not audit for that company. Just remove that auditor from the audit team where his family member is involved in the client. Employment with assurance client, where the auditor is a employee of the client and they are in the senior position in the client company, not just employee but senior position. Okay, for example, your maybe they were ex audit team. Okay, because of this what happens, ex audit team may be able to exert influence over the auditor due to existing close business relationship. Maybe they had in the past they had a business relationship or personal relationship, so because of that now they can influence the auditor. So for that reason, okay, key members of the audit team, the key members of the audit team, they cannot accept any senior appointment and the client for 2 years. Okay, until 2 years have lapsed from the involvement in the audit. That means if you're an auditor, 2 years have to pass before you can join your client company as a senior in the senior position. Within 2 years, you cannot. Next, size of fees. Maybe auditors significant amount of fees from one client. That means he's totally dependent on that one client. Okay, so because of that, auditor will not try to upset that one client because huge amount of fees will be lost to them. Okay, so what should auditors do? They should earn no more. Remember this figure you have to remember it. Okay, they should earn no more than 10% of their fee from one listed company or 15% from other companies. If it's a listed company, remember your fee has to be 10% or below that from one client. It should not be more than that. And if it's other company, not listed company, then 15%. You see, listed companies are more strict. That's why they have kept 10%. Other company, 15%, 5% more. But remember this two figure. Gifts and hospitality. That means auditors are receiving gift from their client. Like let's say car or free holiday, any kind of gift. So because of this, auditors do not want to, who does not like taking gifts? So it creates a familiarity threat. So because of this, stop accepting any gift, especially if the value is material from your client. But if it's a small gift like Maybe a meal you can accept, but not a holiday. Holiday is expensive. Now, which of the following are potential independence issues? See, not all the things are independence issue. Do not take everything as this is unethical, this is unethical, this is not independent. No. That's why I have some questions for you. Okay, I didn't include the answer. Answers are there. It is test your understanding too from your textbook if you go. But I have the questions for you, and I will be giving you the answer one by one, and I will explain you why the answer is so. The first question is, working as an audit junior on the statutory audit of a major bank with whom you have your mortgage. Is it an independence issue or not? Think. You are an audit junior in a bank with whom you have a mortgage. Are you? No. If you say no, you're right. Because do you have any financial check to know whether independence issue is there or not? Remember the 5 types of thread: familiarity, advocacy, intimidation, self-interest, self-review. Check whether any of these 5 are being affected or not. There cannot be familiarity thread, otherwise they would have mentioned about the familiarity stuff. Advocacy, no. They are not promoting the client. Intimidation, no. They are not saying anything about pressurizing, influencing. The word is not used, the term. Self-review, they are not doing anything to do self-review. They are not checking their own thing. Self-interest, do they have? No. So the answer is no. This is not an independence issue. They can work because there is no material financial interest involved here. Second, because remember, you are an audit junior. You are in a junior position, so you cannot have an influence over anything. You cannot have an influence over the outcome of the audit. So you don't have. No. Second, taking on a large new client. Look at the adjectives when they use large, junior, small. This matters a lot. This will give you a hint whether independence issues they are not. So second one, taking on a large new client whose fees will make up to 90% of your total revenue. Clearly you can say this is an issue. From the word only one client, large new client, and from the word 90%. The figure. These two things will tell you yes. Which thread? Self-interest. Self-interest. You are dependent on the fee from one client. And whereas they told listed company 10% and non-listed 15% only, and this is 90%. So it's a self-interest thread because you will always be in pressure to keep this client happy. Third, taking on a new large client whose fees will make up to 10%. Is it this thing? No. Here it's not because it's just 10%. If you lose this client also, it will not affect so much, whereas you have 90% other clients to take care of. Fourth, you're working as an audit partner and you're accepting a gold Rolex as a gift. Gold Rolex, definitely. Familiarity thread is there. Fifth, because gold Rolex, you know, right? I'm sure you know the Rolex watch, luxury watch. So performing an internal audit review of controls that you put in place in your previous role. That means you are an employee, you made design the internal control, now you're only reviewing. So it's a self-review thread is there. Yes, definitely. Sixth, you're working as an external auditor at a company where you have a close personal relationship with the person who has a junior role in the marketing department. Sixth one is no. Even if it looks like because of the word close personal relationship, but read the later one, later sentence. Then the junior role in the marketing department. Junior role, they cannot have an influence over the matter. So no. If they were in the senior position, makes sense, yes. But that also in the marketing department, so no. See, when someone is in the junior position, okay, they cannot have that much significant influence over the audit engagement. In that case, thread is not likely to arise. Depends on your position. Your position matters a lot, where you are joining, at what position. Taking on the audit for a company with which your firm has recently been involved in a share issue. Definitely. Right? Now, let us go through some threads and some examples. So one threat could be you are being pressurized. Okay, you could be pressurized from your supervisor, manager, or director. And because they are being pressurized, it will affect your integrity. Integrity means you will not be honest, the auditor. So what are the example? That means you might sometimes, they might tell you do not report adverse findings if you get, or they will threat you saying that if you do so, we'll not keep you in the employment, we'll terminate your employment if you disclose things, right? Second threat could be an auditor might mislead his employer based on the experience or the expertise that an auditor has, right? But in reality, you might need someone else's advice, whereas this auditor himself needs an expert advice, but he's not taking it because he thinks he's an expert. Example like because auditor might want to retain his position in the internal audit department, so he wants to show he have experience, but to show that he's misleading the employer, which is again a threat. Third, auditor might ask to act against the technical or the professional standard. Okay, so because of that, an auditor might be told to ignore the incorrect application of accounting treatment, or even give an incorrect reporting of directors' remuneration. I mean, just to show fake directors' remuneration, right? They could be told. So you have to see in your exam for all this kind of things. Maybe one or two might come up, pop out in your exam scenario, right? How do you protect yourself? Protection of independence. Make sure that you should also know how to protect independence. Okay. We all know independence is important, but how to protect? The internal auditor should be independent of executive management. Remember, internal auditors are also employees, so it's very easy they can lose their independence unless external auditor are highly independent because they are external. But internal, they have been working in the same company, they know things, so it's easy for them, the employers, to manipulate them, you know. But make sure that they should be independent of the executive management, and any involvement should not be there in the activity of the system that they audit. I mean, wherever the internal auditors are going to audit, executive management should not be involved in that activity. Okay. The second is the head of internal audit. Whoever the head of internal audit should report directly to a senior auditor or the audit committee. Audit committee is there. Okay. If an audit committee is there in the organization, if your organization has audit committee, which most probably you will be having it, more or less every company needs to have it. So this internal audit, head of internal audit, okay, they report directly to them or the senior auditor, one of them. Okay, but they have to report. It's not that internal auditor do whatever they want and they do not report to anyone. At the end of the day, they have to report. So because to report that, things has to be made easier for internal auditor. That means internal audit should have direct access to the chairman of the board of directors, to the audit committee. Okay. Third, audit committee should approve appointment and termination of appointment of head of internal audit. Who decides who will be the head of internal audit? Decided by the audit committee. They will decide. They are the one who are going to appoint, approve that appointment, and they are the one who can terminate them also. Because you need some party, some body to control, no, internal auditor. So audit committee is that one. Later we are going to study the roles of audit committee also. Don't worry. Independence requires this thing. There are two types of independence we are talking about. One is known as independence of mind. The other one is independence in appearance. Independence of mind means, okay, in your mind, it's a state of mind. That means in your mind you have decided you are not going to let anyone affect your opinion. That means you are going to act in a way that will not let you compromise in any of the five fundamental principles. That is, your you are going to act with integrity, you are going to exercise objectivity, you are going to be professionally skepticism about things, You're not going to compromise on those things. It's in your mind. We're going to work. Second is independence in appearance. That means there are certain conditions where you need to avoid, because even if you are independent in mind, it looks like through your appearance that you are not independent, and this can send a negative image, negative this thing signs to people who are viewing you. For example, if the auditors after office or after the audit, they are, let's say they are going to parties, or during that audit session they are going to parties, the auditors and the client, they are going to parties, they are going to dinners, they are going to have food together, they are going on vacations together. So even though they are maybe in the mind they might be independent, but it's more likely that they are not independent. I mean, they are closely aligned with each other. I mean, looking at the appearance, okay, it makes it so obvious for any third person to make a reasonable judgment that the auditor might not be independent. So auditor should avoid such situations to come. You have to avoid going out with your client, hanging out with your client. You cannot be friends, besties with your client, right? So safeguards needs to be applied. Now, internal auditor, they are judged based on their objective of standard. Okay, I'm going to give on the left side the objective and then explain. One is independence. Okay, internal auditor, we know they should be independent. Head of internal audit should report to the audit committee or the senior director, right? Basically, internal auditor, when you're giving them some work, they should be free from interference. No one has to come and interfere in their work. When deciding what should be the scope of the work, okay, when should the work be carried out, okay, and when communicating his opinion also has to be given freely and independently. Second, objectivity. They have to be objective. So when internal auditors are carrying out their work, they should be objective in that work. They should have a kind of impartial attitude. They are not partial towards anything. Any conflicts of interest, avoid. For example, an internal auditor should not provide assurance services for an operation where he has a management responsibility also within the previous year. Third is professional care. Okay, they should exercise professional care, and due diligence has to be done by the internal auditor. And internal auditor should have the competence also. Sometimes it's very likely they might not be competent enough. They have to make sure that they're competent to perform their task that they're doing. Okay, for example, they should have some knowledge of the key IT risks and control and computer assisted audit techniques. This internal auditor should know. Okay, now area of work. Managing internal audit. Who is managing internal audit? The head of internal audit. Okay, they establish risk based plans also, the head of internal audit, so that you know what are the priorities of internal audit work. The internal audit plan should be reviewed at least annually, and the head of internal audit, they should submit the plan of work to the senior management and the board for approval. Someone should approve your plan. No, it's not that the internal auditor wants to do something and they do according to their wish. No, it needs to be approved by the senior management. How independence is mentioned when you're managing internal audit? Independence is maintained by the internal auditor or the audit committee being able to decide the scope of internal audit work. It is either the internal auditor or the audit committee who decides what should be the scope of the internal audit work. Managers will not come and decide it for you. They will not have any say over it. Second is risk management. Here, okay, internal audit department, they identify and they evaluate the risk. Okay, risk in terms of relating to your governance, it could be relating to your operation, it could be your information system, financial system, anything. Okay, here independence is maintained. How? Internal auditor needs to be given access to all the information on all the risk so that they can report freely if any error or any omission has been found. Third is control. Okay, internal audit are the one who are going to maintain the internal control by evaluating how effective and how efficient the control is. Here, maintenance is made how, sorry, independence is maintained how? Make sure here also you give them full provision of information, and they have to have a reporting line to someone whom they can independently report, like audit committee. Governance is the fourth area of work. Okay, internal auditor have to assess the corporate governance process, and they have to make recommendations wherever it's appropriate for them to do. For example, some improvements needs to be made in internal control or risk management. Internal auditor has to do it. Here, the independence is maintained by internal auditor being able to report the breaches of corporate governance code. If any breaches of corporate governance code is there, internal auditor has to report it, and without the fear of dismissal. They should not fear that if they report, they are going to be dismissed. That fear should not be there. Internal audit work. Okay. They identify, they analyze, and they evaluate sufficient information to achieve the objectives of the engagement. Okay. And information that they've identified should be relevant, reliable, useful. And the conclusion is based on suitable analysis and evaluation. Information to support the conclusion of auditor should be recorded. It should be recorded. How the maintenance is maintained, independence is maintained? By showing that normal standards of internal audit work has been followed. That means there is no pressure to cut any corners by the senior management. Or this internal auditor should not decide to carry out the work at a lower standard. No, should not lower your standard. Communicating results. Okay, internal auditor, they should communicate their results. Like what are their recommendations, what are their conclusions, what are the action plans. Okay, and it should be communicated to the appropriate person, not everyone in the organization. Here, independence is maintained by auditor being able to communicate with the committee or a person who is separate from the board. Okay. Now we are moving on to the audit committee. Okay. See, audit committee is basically, it's like a committee that is set up, okay, of the board of directors, and this committee is made up of purely 100% non-executive director, independent non-executive director. Only they can sit in the audit committee. And if it's a larger company, at least 3 people have to be there in the audit committee. And if it's small, 2. And out of those 3, one of them should have recent and relevant financial experience, because auditors should have financial experience. They're auditing financial statements. One example is, let's say there are 3 friends who decided to set up a audit committee. They're all non-executive director. One of them is an ACCA member. So all the requirements are fulfilled, because ACCA is means you have a recent and relevant financial experience. That's the meaning of it. Okay. And the reason why audit committee is there, their key function is so that they can give accountability to shareholders. Increased accountability to shareholders. It makes it very accountable to the shareholder, the organization. And it's very, 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 very critical. Audit committee should be independent. They should be made up of non-executive director and have written terms of reference. These are the features of audit committee. Now, what are the roles of audit committee? Definitely it will be more than internal and external auditor. They are committee. They are the main board that regulates, that controls the auditor, whether internal or whether external. So they oversee work of internal audit, they review internal control system, they review the work of external audit also, and they monitor the integrity of financial statement. These are the 4 roles of audit committee. Very simple, nothing much. Now, audit committee's role in the review of internal control, in detail we'll go. Okay, here what type of controls do they review? Financial control, they supervise major transactions, they monitor how adequate the internal control is, they review compliance with rules and regulations on ethics, review of fraud risk management. They approve annual report internal control statement, and they receive a report from internal as well as external auditors regarding controls. Now, audit committee's role in overseeing internal audit function. We are more towards internal audit because the topic is internal audit, right? They monitor and they assess effectiveness of internal audit. They check the efficiency. They ensure accountable to the audit committee. That means internal audit should be accountable to audit committee. They ensure recommendations are actioned. That means whatever recommendation is given by the audit committee needs to be done. Preserve independence. Yes. Review and assess the annual internal audit work plan and approve the appointment and termination of head of internal audit. Now, Smith guidance says that audit committee recommends that committee meets with internal auditor at least once a year. That means audit committee has to meet with the internal auditor at least once a year. And that when they meet, no manager should be there. And they have to discuss audit related matters. Okay. What if the company does not have this internal audit function? Then what? Then committee should see annually whether they need one or not. Every year they have to check, look for facts whether internal audit is needed or not. And if they need, recommendation has to be made to the board. And also if they are absent, internal audit function is not there, they have to see, managers have to make sure that they explain why they are not there, internal audit, in the annual report. Reasons for absence. Okay. So the audit committee and the external auditor, where they are relying on the internal audit department, they both rely on the internal audit department, they are the employees. So they need to make sure that internal audit department is working effectively. If internal audit working is only not working effectively, how can external auditor and audit committee depend on them? Right? So to make sure that they are working, internal audit needs to be reviewed. How do you review? There are areas, 4 areas through which you can review them. Number 1, you check their organizational status. That means you need to see whether internal audit is objective and independent or not. That means you have to see whether internal auditor are reporting to the senior management or not, whether they can report to the senior management or not, or the audit committee. Because if they're able to do that, their reports will be more credible, right? They have to see whether they are in some kind of fear or not, that if they give this kind of report, they will be dismissed. So any constraints on internal audit, such as the areas of control system that they cannot look at, you have to see, do they have the access to the internal control, or internal auditors have said no, you cannot have any look at the control system, or is there any kind of restriction in the internal auditor's work? If they do so, understand that maybe the managers are, it's a clear this thing that managers are attempting to hide discrepancies. You have to be aware of it. There you cannot rely 100% on the internal auditor's work. You have to do your own work. I mean the external audit and the audit committee. Finally, the internal auditor is allowed to communicate directly with the external auditor. They have to be done. And if there is any limitation, managers say no, you cannot communicate, then understand manager has something to hide. Second area is to review is look at their scope of function. That means they have to be given. See, external auditor, they should be allowed to have unlimited access to the books, records, and control system in the company. Okay, so any report and recommendations that are made by the internal audit, they should be acted. And if they're not acted, management should say why in the report. Okay. Third area is technical competence. You have to see whether internal auditor has the technical competence to do that work or not. The more technically competent the internal auditor is, it's good for external auditor. Their work will reduce. They do not have to do detailed testing and all. They can rely on that work, right? And if they do not have the technical competence, make sure training is given to the internal auditor so that they come up to their standard. How do you make sure these things are there? Make sure when you're recruiting, you are having some standards, recruitment standard, that they meet those standards, then only you're going to employ. Otherwise, no. And if you do, give them training. Fourth, due professional care, the last one. Okay, that means the internal auditor's work should be planned, should be supervised, should be reviewed and documented. You need the documents because external auditor is not going to decide, uh, base their decision on the internal auditor's work just based on word, whatever the internal auditor say. No, it needs to be documented. Because if documentation is not there, means quality suffers. Okay, you're working at a lower quality. Okay, so when you're reviewing, you have to make sure working papers are produced, work program is there, work has been carried out in the time given in the standard, right? Now, audit committee and the external auditor. So, audit committee in this respect regarding external auditor committee have a prime responsibility. What is it? That they can appoint, they can reappoint, and they can remove the external auditor from the board. Second, they oversee the selection process. Whenever new auditors are there, they see how they are going to select. Third, approve. They approve and also remuneration is set by them for the external auditor. And they make sure that annual procedures are there for ensuring independence and objectivity of those external auditors. They review the scope of the audit with the auditor and they satisfy that this is sufficient. They make sure that plans are there in place for the audit at the start of the audit. And they carry out a post-completion audit review. Post-completion means after the audit is done, they review it again. What does post-completion review includes? Three things. Number one, check for error. If any error is there which is identified during the audit. Second, key accounting or judgments, audit judgments, review it. Third, any major issue that arose during the audit, discuss and see whether they have been resolved or not. These are post-completion. Now, how do audit committees make sure that independence of external auditors are maintained? They seek reassurance. From whom? From the auditor itself. That their staff, okay, the auditor himself and their staff, they have no family, they have no financial, they have no employment or any kind of business relationship with the client. And they obtain each year from the audit firm information about his every year, not just once and it's over. No, every year audit they get this information from the audit firm about his policies and process for what, that they are maintaining its independence, how they are maintaining its independence, and how they monitor compliance with professional requirements, such as any rules regarding rotation of the staff or the partner. Next, audit committee, they have to agree with the board and monitor the company's policies on employing former employees of the external auditor. Sometimes they can do that. They can employ former employees of the external auditor. So what are the company's policies? Audit committee will check that. Okay. Develop and recommend to the board the company's policies on the recommendation of non-audit services, because non-audit services can give a lot of threat. And non-audit services are usually given by the external auditor. It was not there for the internal auditor, but external auditors, yes, they do give. Like tax service, financial management, recruitment service, right? IT service. So this provision of this non-audit services, when you're giving it, it must not impair the independence. The audit committee should establish a policy that specifies the types of work. That means these are the types of work that auditors cannot do. They exclude it. These are the types of work that they can do, but they need reference to the audit committee. Without reference, they cannot. Without reference, they can get engaged. Then there are some where case by case decision is required. Every case you see individually and say whether this type is accepted or not. For certain classes, yes, pre-approved is given, but for certain, it's not given. Okay. This policy, they might also set the fee limit. That means for particular class of non-audit work, this should be the fee, right? Like that, you can decide. The last topic, subtopic for this lecture is reporting on internal control to shareholders. Okay. See, shareholders, they are the owners of the company. So they are entitled to know what are their internal controllers, whether they are working perfectly or not. Okay. And when you're doing it, when you're reviewing internal control, there should be some standard. How do you do it? Against what? Against something, and you need to check, right? Against the co-source element. What is the co-source element? Remember the 5 element? Control environment, control activity, risk management, information and communication and monitoring. I've explained this in my previous lecture. So go there and check what is this co-source element. That is lecture 26. The annual report, they should inform the members of the work of audit committee. Okay. The chair of the audit committee, they should be available at the AGM. So that if shareholders ask them any questions regarding their work, they should be able to answer it. And additional reporting requirements apply under Sarbanes-Oxley Act. Audit committee reporting. Okay. There is a section in the annual report, okay, that says what is the work of the audit committee. Okay. Go to any audit report of any company and see. It will be there. And this should include these things. What are the summary of the role of the audit committee? What are the names and the qualifications of the audit committee members during that period? What are the number of the audit committee meetings that is held during the year? The report that how audit committee has discharged its responsibility, and if external auditor gives non-assurance services, how independence is maintained. Okay, internal audit reporting. So many reports are there, right? This is once an internal audit control audit has been completed. Okay, then you give this audit report. So here for internal audit reporting or internal audit control audit reporting, there is no prescribed format like that. Okay, but it has some features. Okay, and how much should be the depth of the report? It depends on the nature of the engagement. Now, these are the report section, these are the reasons and explanation. Examples. Objectives of audit work is there. Okay, because it sets a scene for report audience. I mean, when audience first comes to that report, they should know what is the scene like. What is the purpose of the review? For example, payroll audit check. It could be a payroll audit check, right? Whether wages are paid to the correct individuals, deductions from the gross pay are properly calculated. Second is summary of the process that is undertaken by the auditor. What are the reasons? It gives evidence to support the opinion and the recommendation that is gathered. For example, you have done recalculation of deduction. Okay, but you have done it on a sample. Obviously, you cannot do for all the employees. So just for the sample of 50 people, you have recalculated the deductions. Okay, for 50 monthly and for 50 weekly wages payment. That's the summary of the process that you have done. Third is, what is audit opinion if it's required? So this gives summary of whether control is reviewed, control reviewed is working or not. Example, in our opinion, control is working as intended, or control is not working as intended. Anything. Recommendations. Finally, this is then the internal audit report. Okay, you highlight the areas of control weaknesses and you suggest what should be the recommendation. For example, we recommend that new employees are only added to the payroll system on receipt of an appropriately authorized Form 1A. When you're taking on new employee for the payroll system, make sure that you take them on a based on receipt on an authorized form. That is 1A. You don't have to know what is this 1A form and all. Not relevant. Now, recommendations. Always, recommendation should ensure that when you're giving recommendations, they have to be practical as well as cost effective. It should not be very costly. It should reduce the risk to a tolerable level. Okay. An internal auditor should have a process of post implementation review, so that you can see whether recommendation has been acted upon or not. Now, let's summarize everything that we have discussed. We have reached the end. So we've started with internal audit. What were their roles? Right? These are their few of their roles. They review accounting and internal control system. They examine information. They assess risk identification. They review the 3Es, economic efficiency and effectiveness. They do special investigations to fraud, review compliance with laws, regulation. Then we went through need for internal audit based on scale, diversity, complexity, number of employees, cost benefit, changes in structure, change in key risks, problem with existing control system. Then we went through unacceptable events. Then we went through features of internal audit, organizational status, scope of function, technical competence, and due professional care. Organizational status means they should have someone to report. Hierarchy has to be there. Head of internal audit has to be there. They have to report to the senior manager or audit committee. Scope of function means they decide what should be the function, or the audit committee, but manager does not interfere. Technical competence means they should have the experience, the knowledge, otherwise get trained. And due professional care means everything needs to be planned and documented. Okay. Types of audit work. There are a wide range of audit types. We saw social and environmental audit, financial audit, management audit. Then we went through the auditor's independence and why it is important, because third party is relying on the auditor's report. And there are 5 threats to independence. Self-interest, where you have financial interest like shares in a company, in a client. Self-review, auditors are checking their own work. Familiarity, auditors are became very close with their client. Advocacy, they promote the client's position. And intimidation, where auditor have a risk of being getting pressurized by the client. Then how audit committee is made up of 100% non-executive director, at least 3 member, one with financial experience. What is the role of audit committee? They review internal control system, they review internal audit, external audit, and integrity of financial statements. Then reporting to shareholders, we went through the various reports. Okay. And make sure that reporting to shareholder, it is something has to be done because it is an important corporate governance requirement also. Even though you do not want to do it and say it's a voluntary thing, it's not compulsory. No, corporate governance says so, you have to do it. It's a requirement there. So even if you do not want to do it, through corporate governance you have to do it. Report. Because otherwise shareholders will not know whether internal control is working or not. And if internal control is not working, their assets will not be safeguarded. The investment will not be safeguarded. The shareholders. So these things matters. So that's it for this lecture. Thank you for watching, and this is the last lecture under section E. Now next lecture will be focusing on new section, section F, finance. And before I leave, if you have not subscribed to my channel, do subscribe to my channel. I have a whole playlist on SBL lecture. The previous lecture, lecture 1 to 25 or 26, you can watch that playlist, and this is with this lecture. Make sure that you do and share it with your friends. Thank you for watching, and see you in the next lecture.